investors. Welcome again, Joseph Areu, hosting you. And I'm speaking to you today in May. May means second quarter. And second quarter, for those of you who follow the markets, in our region means dividends. So this is the time when many companies are declaring dividends. Companies which had their accounting year ending in December, they have done their audits and they have now declared dividends. So this is quite an exciting time to be thinking about buying shares so that you can benefit from the dividends. And therefore today I would like to talk to you about that process of buying dividend shares, that whole process of the declaration of dividends and what happens thereafter, so that you are aware when this happens and you know what to do or what to expect. So when a company declares dividends, or let's step back, when the audit is done, a company is then able to declare dividends based on its performance. And when that happens, the company will, of course, announce how much it's going to pay in dividends, if at all, per share. Secondly, the company will announce what we call the date of closure of the register, or sometimes they will say when the books will close. That means when they will essentially close the dividend register. So beyond that date, whatever shares you buy will not be eligible for a dividend. But before that date, every share that you buy will be eligible for a dividend. Okay? The company will also announce the date for the AGM, because whatever dividends are declared will have to be approved at the AGM. And finally, the company will announce the date for payment of the dividend. So, once the date of closure of register is announced, it means from the time that the dividend has been declared to that date when the register closes, that share will be trading cum or cum dividend, CUM dividend. That means whatever shares you buy during that period will be eligible for a dividend. And also, of course, whatever shares you hold during that period will also be eligible for a dividend. So when you see the word CUM-dividend, or sometimes they just say CD, the shares are trading CD, cum dividend, it means that whatever share you're buying at that time will attract a dividend. So what that usually means, or one of the things that means, is that the price of the share is likely to go up by the amount of dividend that has been declared. Of course, it's not as mathematical as that. In other words, it's not like you just add the amount of dividends. So if the dividend declared is 1 shilling, you add it to the price of the share before the dividends were declared to get the total price of the share. It's not always as mathematical as that. Depends on the demand and the market dynamics. But generally, the price of the share will go up. Okay? That said, though, it's still a good time to think of buying shares because of two things. One, even if the price goes up a little bit, you're essentially buying the share at a discount. Right now in our region, share prices are so depressed already. So imagine you're buying this share whose prices are depressed, and then you're going to be paid a dividend. So essentially you're buying the share at a discount which is equal to the dividend that you will be paid. Like I said, prices will go up, but they don't necessarily always go up in proportion or in an amount equal to the dividend that has been declared. So there is a built-in discount to the share that you're buying by the amount of dividend that you will be paid. Secondly, imagine you buy the share at the time that the dividend is declared. Usually it will take about maybe up to about 2 months before you are actually paid that dividend. So suppose that the dividend yield is about 10%. It means that in about 2 months you are going to be paid a return of 10%. Think about like an interest of 10% on the cost of your shares. But you're being given that interest of 10% within 2 months. Normally interest is paid after 1 year, right? But this time you're going to be given that interest of 10% within 2 months. So if you calculate the annual rate that you are receiving, the annual interest rate, quote unquote, that you are receiving, it's actually about 60% per annum, because you're going to be paid within 2 months. So it's actually about 60% per annum. How many investments will give you that kind of yield? It's very, very difficult to come across them. That kind of return you can get by buying a dividend share. In other words, buying a share cum dividend, CD. Right? Now, once the register closes, so usually it would take on average about a month from the time that the dividends are declared for the register to close, for the books to close. Okay? Meaning the share then starts trading without the dividend, what we call in the industry ex-dividend. Sometimes you would then see it written XD, ex-dividend. All that means is that whatever shares you buy from after the closure of the share of the dividend register will not be eligible for any dividend. So what then happens at that point is that the price of the share will come down. It tends to come down, again subject to market dynamics, subject to market sentiments, subject to market demand. But generally the price would come down, right? So you want to time your purchase. If you want to benefit from the dividend, you want to time your purchase in such a way that you buy the share when it is trading cum dividend, when it is trading CD. You can always ask your broker to tell you which shares are trading cum dividend, which ones have declared a dividend, which ones have not. Therefore, which one is trading cum dividend and which one is trading ex-dividend. But my general message to you today is that buying shares during or when a dividend has been declared might be something that you would seriously want to consider in order to get basically shares at a discounted price, because you're going to be paid back some of the money you have put in. And secondly, you are essentially enjoying a very good yield, given that you're going to be paid that dividend in a very short time. very many companies, as I said, are declaring dividends. Usually it's around about second quarter, which is around about the time I'm talking to you. The average dividend dividend yield, in other words, the dividend being paid as a percentage of the price of the share, would be in the region of about 5%. But in our region today, the company is paying dividends as high as 10% or more. So it is something that you want to watch out for and take advantage of to get yourself a good dividend. Thank you very much for listening. I hope this was useful, and I will be talking to you again soon. Please, as before, try and subscribe so that you always get notification of my subsequent videos. And if you need to get in touch with me for any further clarifications, ask any questions related to what I've been talking about, or indeed anything else, do reach out to me on my contacts, which are at the bottom of your screen. Thank you very much.